Hey, Delynn, check out this new house that I want to buy. And I got a new calculator. And I'm going to just
You're
check
just
out.
so proud of that calculator
I
on your
am.
phone, huh?
Listen, I'm crunch.
I've had mine on my phone for like, I don't know, 10 years now.
All right. So I'm just seeing if I'm going to qualify for this house. So give me just
For
a
this
minute.
island.
Oh,
That's a
it's
lovely
mine.
island. Why don't you just buy Mars instead?
Hello, everybody. My name is Barry Horvath, and this is Moving Forward TV, your local market update.
And I am Delynn Gaston. Thank you for joining us today. So, are you going to buy that house on an island?
My calculator answer is
What did it say?
no.
Do you not make enough money to buy that?
No.
So today, what we decided, we're going to talk about some of the things that can affect the qualifying. And there can be pretty big swings in what you qualify for. So, as you know, a lot of our real estate partners, when they get a new client, a new person comes to them and says that they want to buy a house, one of the first things they'll do, if you're a good agent, and most of you are, is refer them to a good mortgage person to say, make sure they qualify. And what do they qualify for?
I think what you're saying is most of them. Who are you referring to that doesn't? Oh, wait, the ones that don't,
good ones.
the ones that aren't closing deals. We're just kidding, of course, but we're not.
I know,
But-
because a lot of things go into it, right? And it's a big swing that a lot of people don't realize. It's not an exact science for what somebody qualifies for because it could be such a big difference. The littlest thing can make a big difference. For example, $100 in a car payment could make a huge difference. You know, a few $1,000s in income, a raise or overtime or something like that can make a big difference in what they qualify for.
Yes. Speaking of exact science, I know you don't watch football. All right.
Didn't take us long to get into sports, did it?
No, we got to go where people want to go. So, you know, the referees, there's no science to it. They watch the running back or the wide receiver where they fall down, and they spot the ball where they believe it is to be. Okay, so there was
Is believe the key word here.
believe, yes. So they spot the ball, okay, and it's going to be a first down or a turnover for the other team to get the ball. The ball is right at the stake for the first down mark. The referee pulls out a piece of, it's this close. He pulls out a piece of paper, folded over, puts it in front of the ball and the first down marker to
you
see
kidding?
if it was a first down. And it just touched the ball. So he's like, first down.
Wow.
And you know what? And the announcer says, well, the paper was folded over, so that was an advantage to the other team. Anyway.
Wow.
So, yeah, there's no exact science to anything in the world. Forget about mortgages. It's life in general.
But although I will say that football story was definitely better.
I know.
That was pretty good. All right. So anyway, so back to mortgages.
So-
Sorry for the detour there.
So what is it?
And the lesson in first downs.
There's a lot of things that go
So
into
yeah,
qualifying.
there are a lot of things that go into qualifying. So
Tell us like 36 things, because that's all we have time for
I know,
today.
and you know what? And what I didn't even put on our sheet
What?
is some of the things, you know, again, when our real estate partners say, hey, qualify this person for me, let me know how much they qualify for. How much are the taxes going to be? How much
Yes.
is the insurance going to be?
And how much is the HOA going to be?
How much is the HOA going to? All of those things affect. So here, we figure we would kind of like work it a little bit backwards. So in the mortgage world, what we do is we go
Shocking us doing
monthly.
something. Us doing something backwards.
being a mortgage. Being a mortgage is based on monthly payment. What is the monthly payment going to be? So everything we do goes into per month. So what is the income per month? What is the taxes per month? What is the insurance per month? What is the HOA per month? What is their car payment, student loan, whatever their debts are per month? We work everything on a monthly basis to come into how much payment, after they pay everything else that they have to pay, how much payment is left to pay a mortgage payment of principal and interest only.
And remember, on our last show, we just talked about the new rules from Fannie. And,
Right.
and, you know, it's all about the debt ratio. How high will the lender let you go
Right.
into that ratio?
And that's what I was just going to bring up, the same thing.
You know, now we know on Fannie and Freddie, who is the buyer of most end loans, we can go to 50% debt ratio.
Which is big. Many years ago when I started in this business, that ratio was 36%.
Was it really?
Yeah, it was 28
Gosh,
and
you've been doing
36.
this too long.
Too long, man, too long. 28 and 36. 28 was the housing payment, 36 for all of your other payments, your car
So-
payments, your credit cards, everything else. Couldn't exceed 36%
Can we put
of
it in-
your monthly income.
So in layman's terms,
Now that's up to 50%.
layman's terms, what that means was before, if you made $1,000 a month gross, not net, gross income, your maximum debts in your day were $360, 36% of the $1,000. In today's world, we can go up to 50%, which is $500. So that gives you $140 more a month buying power than you used to have. And you know, even like VAs are going, because it's a government insured loan, VAs will go over 50%.
Right.
They could go as high as even 55.
And
we've
even
seen.
FHA in some
FHA
cases can
will
go
go
a
to
little bit
55.
higher.
So that same payment, you know, you're making that same 1,000 a month gross, you could go to $550 a month in total debts. Now, remember all the other things that are included in your debts,
Right.
like, and we're
Yours.
going to talk about all that. I know you have it all written down.
I know, your student loans, your personal loans, your credit. But before we go to break here, I don't know how close we are, but but let's talk about what's not included.
That was my break. Oh, that
I
was
don't
a
know
bad
what that
shimmy.
is, but why did I do
Oh,
it
wait.
too? I don't know.
because you are a product of your environment. You were sane till I came into your world. Now you're crazy.
Gone. Anyway, so some of the things that are not included in the debt ratio, let's just run those real quick because a lot of people, again, they're very mistaken on some of the stuff that we need to take into consideration and things
so-
we don't.
Things that we don't care about, your car insurance, we don't care.
Nope.
We don't care about your electric bill.
Nope.
We don't care about your cell phone bill. We don't care about your water bill.
Nope. Although you'd think that we should, but that's why we're only using 50% of your income because we realize you have to buy groceries, you have to put gas in your car, you have to pay an electric bill, you have to pay a water bill, that kind of stuff. That's why we're only using 50% of your income to go towards a housing payment, your car payment, your credit cards, things like that. Because the other 50% is for your FICA taxes, your Social Security taxes, gas in your car insurance. Here's one, though, that isn't taken into consideration. On any mortgage product except VA is the only one who takes it into consideration, and that's childcare. Daycare. I can remember when my kids were little, man.
That's right.
Might not have been a real expense to
right.
the mortgage industry, but it was a real expense to me.
Yeah.
You know, $200 a week sometimes, and sometimes more. I feel bad for these people that you're dishing out a week.
And
in
it counts
car payments.
directly into your debt ratio for childcare.
Or it doesn't in any mortgage product except VA loans.
So we have to remember that.
Yeah.
You
So
know,
we don't want you to push all the way to that 50%, you know, especially if you have small kids that you're doing daycare with, because we don't want you eating ramen noodles for the rest of your life.
ramen. They're ramen.
Ramen, whatever.
All right,
whatever.
listen. You know what? Nobody cares about what we don't care about. What they do care about is what we do care about.
That's what we have written down here.
But we're not going to tell you till right after this. Okay, we're back talking about qualifying. What do you qualify for? How do you qualify? How do you,
What kind of swing it could make.
yeah, let's talk.
Little changes.
Let's talk about that swing.
Yeah.
Is that baseball?
Hey,
It's not baseball season.
I kind of had hunches. Got to bring that
was
up.
kind of a
It's
gimmick.
not baseball season. That's
I
done.
know.
I know you're into football and hockey right now.
Not really into football.
Oh,
My
yeah,
team's
they did
kinda
bad
out.
the other night, huh?
Yeah, my team's out.
I know. Sorry.
It's okay.
All right, so let's talk about the other exciting part of your life is mortgage qualifying. Yay!
Fine,
Yay!
fine. All right.
Mortgage qualifying.
All right, let's talk about those swings. So let's pretend that you're working and you have a job. And
So
you
for three things that are going to make a difference, your income. Sorry, you didn't go to the three things. I even wrote them down for him. Your income, your debts, and the rates and terms of the loan. What the interest rate is, and is it a 30-year or 50-year?
let me know when you need me.
Those are three things that are going to make a difference. Now you can go. Go ahead.
Okay.
Go ahead.
Okay, so the three things we're going to talk about that affect your loan are the income, the rates. Sorry, it had to be done. Anyway, so that was really good. You got to admit, that was funny. So let's talk about the effect of, let's pretend you're working and you make $50,000 a year.
Okay.
And all of a sudden you get a pay raise. So now your income is higher. And I always like to create the analogy. It's like, for those of you who are in business, you know, you have a threshold that if you make $10,000 a month, that's your break-even point, all expenses. Everything above that is gravy and profits. Well, it's no different in the mortgage world, because when you make this much income, everything above that debt ratio threshold is gravy.
Right.
So it can make your buying power much more significant. So if you went from $50,000 a year to $55,000,
You get a nice little raise, $5,000 a year.
yeah, $5,000 a year. That's going to actually change how much you qualify for by quite a bit.
How much of a difference is it going to make?
I don't know. I can't read your writing.
And I can't read that far away. What did I put? What did I put? All right, so that could potentially make, wow, that could potentially make like a $40,000 difference. Again, it depends on what your debts are, which we're going to get into next, but that could make, you know, just a $5,000 raise could potentially make a $40,000 difference, roughly, rough numbers,
So
in what you, how much house you get. So instead of a
$150,000 house, now you're buying $190,000 house.
$190,000 house.
That
Pretty
is a big
nice,
difference,
right?
over $5,000. So my recommendation is, everybody, when you go house shopping, the first thing you need to do is go to your boss and say, hey, listen, I'm buying a house. I need a raise.
There you go.
And then you can tell him, we told you to ask him. And you can blame us. Then it's really uncomfortable to ask for a raise, So you can just say, Barrington Lynn said I need a raise so I can buy a house. And it's really,
And you'll get it.
and it's really good for the cycles of economy, because think about what you're doing. First of all, you're giving your mortgage company a deal. The seller is getting a deal. Your realtor is getting a deal. Your title company is getting a deal.
You're going to go to Home Depot.
You're going to go shop. Think about what you're doing. It's good for the country. Just do it. Go ask for a raise. There. You think?
I think you're right. Dead on. All right. So some of the other things that can make a difference, and we did just want to touch really lightly, when it comes to your income, if you're working for somebody or if you're self-employed. That's about all we have to say about that.
Yeah. Well, and of course,
If you're self-employed.
If you're self-employed,
Big difference.
That's a whole nother show, folks.
Yeah. So
Whole nother show.
we're just touching. We're not going to talk
And
about
of
that.
course, if other forms of income, if you're getting child support, that counts. If you're
Yes.
getting alimony, that counts, as long as it's going to continue for at least 3 consecutive years.
One of the other questions that I get a lot too,
Social Security.
I was just going to say, yeah, that's exactly it. People, for some reason, don't think that if just because their sole source of income is like a pension or a Social Security or something like that, that they can't get a mortgage. Not true. Absolutely, positively, that income counts. So don't feel that you can't buy a house just because all you have is Social Security income.
And if you get a raise from the government, which is highly unlikely,
They get about 4 cents a year.
Yeah, 4 cents. So that 4 cents will qualify you for another 0.42 1/100ths of a cent of a house. So
There you go.
it's got to be worth it.
Upgrade.
Yeah, so those things all definitely take
Right.
into consideration. The more income, the better,
Right.
obviously. Now
Now-
let's talk about what's next.
Debt.
Boy, debts can make a huge difference on what you qualify for a
And
mortgage.
the smallest little thing. So if you have car payments are a killer. I'm just going to say it right now. They absolutely positively are going to affect what you qualify for, and how much you qualify for. A car payment difference between like $350 and $450 easily is 10 grand right there.
Yep.
10 grand in your what you
It's
can qualify for
$42 a
house.
month, $50 a month.
There
in
you
payment
go.
That that's a big swing
which
for you.
cuts into how much house you can buy. So now instead of buying that $250,000 house, now you're down to a $240,000 house.
And remember, it's not just the car you buy. Remember those kids that go, Daddy, 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 can you co-sign for
Right.
me? Or your little niece that's so cute and you co-sign. That can be considered part of your debt if you can't prove that they are making the payments for you consistently for 12
Right.
months.
Right.
And if you can't, guess what? You're going to get hit with that debt and you're going to qualify for less home.
Documenting that, as he said too, they have to prove it. It's not always the easiest thing. So if the child is giving you the $350 in cash and you're writing the check out of your checking account, not going to work. It has to be that person writing it
And we've
themselves.
also learned that child support,
I was just going to get onto that one as well.
child support, while it does count as income, if you can't document it consistently, is it 6 months now? Depending,
12 months.
12 months consistently
Yes.
for the same amount.
Yes.
It has to be consistent deposit. So,
Right.
So even though it may say it in your divorce decree, guess what? If you're not getting it via the state or consistently into your bank account via direct deposit, they're not going to count it.
And consistently, like Barry said, the exact amount. So don't let the person who's paying you child support, don't let them say, well, I'm going to give you, $200 in a check and the other $100 in cash or something like that. Can't count it at all. If it's not exactly matches exactly for 12 full months, proof of the check that he or she gives you, then we can't count it at all.
Right,
So
so-
a lot of documentation when it comes to alimony, child support, or a debt that you're not paying.
Think of it this way. Remember the ratios. You're getting, example again, $500 a month in child support, and you can't prove it or it's not consistent. On a 50% debt ratio, you're losing $250 of payment buying power.
Wow, that's going to really cut into how much house you can buy.
Oh,
Yeah.
how much?
Oh, how much? He's going to pull out his nifty, difty
My new qualifier. I love it.
qualifier.
Yeah, so
So while he's looking that up, the other thing that I wanted to talk about real quick on debts is student loans. I know we have to take a break in a minute, but student loans, whether they're deferred or not, we still have to hit a payment with them in most cases. There's definitely
Guess
some
what?
things with that. How much is that?
that
$250.
that $500 a month child support payment is the difference of $52,365 a month.
Wow. So
based
you
on
just
a
went from a
4%
250
interest.
house down to
A 200.
a 200 house.
Make them pay you consistently. That's all. Or she.
Yes.
We'll be back. We got more information on rates and how it's going to affect you. Did you get your glasses? Sorry.
I thought he was going to leave it in. My
Listen,
glasses dropped right
That's
before
it.
we came.
Hey, it's a good thing no one's going to cut this part of the show out because it's important you know what happens between the sets. While
We're a
you're on
mess.
break watching our great sponsors,
Yeah.
we're doing really productive things behind the scenes. So that's all I'm going to say about it. All right, let's talk about rates because everybody says, "What's my rate? What's
Right.
my rate?" Does it matter? Well, yes. But
Yes.
it's important for you to know because you're worried about what your monthly payment is going to be.
Right.
But more importantly, how does it affect your qualifying? Because
Right.
we're talking about qualifying.
So in talking about qualifying and how the rate affects you, your interest rate can affect your qualifying even by the slightest little amount, what you can qualify for. So just for rough examples, If the interest rate is 4%, they're talking about in 2018 that interest rates are going to gradually start to increase.
To
Couple
the
of
upper fours.
Right, to the mid to upper fours is where the predictions are going. So how much does that 0.5% interest rate mean? Between 4 and 4.5? It doesn't seem like it's that much, right? It's like, oh, big deal. It's a 0.5%. Who cares? That 0.5% can actually equate to about $15,000 roughly in what you can qualify for. So again, if you qualified at a $250,000 house and the interest rate at 4% and the interest rates go up to 4.5, let's say by next fall, then now that $250,000 house that you qualified for in January and you didn't buy, now your qualifying just went down to $235,000.
Wow, you could do that math in your head?
I did it.
I'm impressed. Did you write it out ahead of time?
Paper.
Because usually, when you throw numbers at her, she's like, wait, let me do it. I got to do it.
I know.
I'm sitting
2 plus 2. Hold on, let me get my HP out.
That's it. I'm on my phone too, but I'm tweeting and she's calculating. I already did it in my brain.
I can't do anything without my HP. I
All
can't
right,
even
so,
use a regular calculator. I have my
think
HP.
It's so important to know the rates are going to affect your buying power.
Right.
So, if in an uprising market, the same exact house you may no longer qualify for. So keep that in mind.
And the other thing that we did want to mention and give a reminder on is the real estate taxes, right? Real estate taxes and insurance on the house. So again, we in the mortgage world, we look at monthly payment. How much is your monthly income coming in and how much are your monthly debts going out? So what else goes into the monthly debts going out besides your car payment, your student loans, your credit cards and things like that, but the taxes on the house, the insurance on the house. And oh, by the way, the house that you're looking at, does it have flood insurance? There's a huge difference.
All part of that qualifying
Right.
ratio.
So if your insurance is $1,000 a year on the house that you're looking at, or is it $2,000 a year? Or maybe it has flood as well, so now we're at, $3,000 a year for both of them together. That's all going to lower how much house you can buy because these other payments are coming
Well,
out.
here's the big question. Everybody keeps asking. I want to pay my house off sooner.
Yes.
15-year, I want a 15-year mortgage. All right, let's talk about that 15-year versus 30-year. From a qualifying standpoint, that can make a huge difference. So you might think, oh, I want a 15-year, which,
Admirable. We
Yeah.
understand. You want to pay your house off fast. We get that.
which is probably a bad idea. But anyway, that's another show.
And I was going to say, he's going to talk to you about that if that's what you
That's
want
another
to
show.
do.
But, let's talk about qualifying for a 15-year versus a 30-year. I know you worked out a little example during the break, Delyn.
The numbers.
Yeah, so
numbers.
how much difference does it make on qualification if I'm going to do a 15-year versus a 30-year?
$100,000.
Stop it.
About $100,000. Is that crazy or what? So it might be nice that you want to pay your house off in 15 years. And this is what I tell all of my clients who say to me, oh, but I want a 15-year, but I want a 15-year. Well, either you don't qualify for the 15-year where the payment is, but I'll tell you what the payment is at 15 years. It's not doubled. So a lot of people think, oh, if my payment is, my mortgage payment is $1,000 a month, I have to pay $2,000 a month to pay it off in 15 years. No, you don't. It's usually just a few $100s more, maybe $200-$300 more a month that goes towards your principal in order to do that. But I'll tell you, it's going to make a huge difference. So that $250,000 house that you qualify for, because it's spread over 30 years, if you shorten that term to 15 years, now you only qualify for about 150.
Can I give my 2 cents on that too?
Yeah, I knew you.
Because
This
I
is his. This is his
It's my hot
spot.
spot. It seems great that you're going to do that, but I always say, what if? What if?
Right.
I'm going to get a lower rate with a 15-year. I'm going to pay off my debt sooner. But what if you lose your job?
Right.
What if you get sick? All these things, and you did it for 10 years, and all of a sudden your house is almost paid off, and you can't afford that extra payment.
Right.
If you did a 30-year mortgage, the way it's amortized, you could pay extra principal if you want to. It will come directly off the principal and reduce your term.
Right.
Or if you're a wise man, you might take the money and put it somewhere else to work for you. Just saying. But
And I was just
you
going
know what?
to
Rates being so low, why
know.
not do that?
I was just going
That's
to
a
say
whole
that
nother show.
it's a whole nother show, but it's really just don't get that stuck in your head to pay your house off, pay your house off, pay your house off. And I know Dave Ramsey is a wonderful person.
Sorry,
I know that's
Dave.
one of
He
the
watches
things
our show.
says. However, like Barry says, so like I said, you don't have to double your payment. So if your payment's $1,000, it's not $2,000 to pay it off in 15 years. It's only like maybe a few $100s more. But I'd rather see you take that few $100s more and put it into an investment account. So God forbid, 10 years from now, you got 5 years still to pay on your house on that 15-year mortgage. But 10 years from now, something catastrophic happens, you lose your job or whatever else.
You got money.
You got money.
And not
you can
equity.
make your payments. You
Yeah,
don't
not
have to
just
sell
equity,
your house.
not equity that you can't even access because you don't have a job and you
So
don't
you can't get an
qualify for a
equity
loan.
loan.
I know.
But you got money in the bank and you could continue to make your house payments until you find another job.
I love it. So guess
I do
what?
too. What?
It's time to talk about community events.
Is it really already?
Yeah,
Wow.
yeah.
Boy, this time goes. Time flies when you're having fun.
Yeah, isn't this fun?
This is fun.
Let's do this every day.
Right up there with football and hockey. This is your next favorite thing to do is talk mortgages.
Yeah. Where's that sharp object? All right. So
right.
what do we got going on in the community?
Oh,
so
all kinds of fun stuff.
So the first thing we want to talk about is January 11th. I know.
Coming up fast here.
Yeah, the Lightning lost with 2 seconds left last night. I know it wasn't last night for you, but it was for me. They
Yeah, that
lost with
hurt.
2 seconds.
That hurt.
That hurt big time.
I know.
Big time. Tie game, but they're on a run. They've won 7 in a row. Pretty
I know.
pretty strong. They're
That's
number
quite
one
the
team.
streak.
So we got a bus trip coming up January 11th.
And that, especially whenever the Lightning is doing really well like they are, that's going to sell out fast. So if you haven't already gotten your tickets, you can get them at WPBA.biz.
or .rocks. I love that. WPBA.biz.rocks. Very reasonably priced. Little discount for members.
Right.
We're going to meet
And
up
it
at
includes-
Village Green. Includes appetizers before the game. We're going to have some beverages on the bus, your game ticket, your parking, your gas, the whole deal. So
Right. So you don't have to worry about driving, traffic,
No, it's like under
anything
50
else.
bucks. You better
And
do it.
it's a lot of fun.
First 50 people get to go. That's it.
That's it.
And it's great networking. We meet a lot of cool people on the bus.
Yeah, we do.
And then we bring 50 to the game, and we bring back 47. That's just the way it
Hopefully
works.
50 back.
So it's a good time. All right, other big events coming up. We got the Taste of Trinity. Taste of Trinity is, going to be at Seven Springs Country Club, January 27th. We still got a few vendor
No, it's at
spots.
Seven Springs Middle School
What did I say?
Country Club.
Seven
Don't go to
Springs
Seven Springs Country Club because
the
it
middle
won't be there. It's going to be at Seven Springs Middle School.
Sorry, there's a plug for one of our other, people in the community. We're always out supporting them. So anyway, good stuff coming up. Like us, share us. We're on LinkedIn, Twitter, Instagram, Facebook, Tumblr, all
Lot
those
of
things.
stuff.
Yeah. So share it, like
We
us,
appreciate you guys. Thank you so much for watching. We are today and every day.
moving forward.
We'll see everybody next week. And by the way, Happy New Year.